Good morning, traders and investors. My name is Roger Scott. I'm the head trader for Wealth Press. Today is the 17th of December. The year's almost gone. Christmas is almost here. And what can I say? What a year it's been. Let's talk about the futures before the opening bell. We've got three big reports coming out today, and I want to show you where the money is flowing as of right now. I think that's really, really important to give you guys a good perspective of what's going on, what's a good place, what's a bad place, where the danger zones are, where the risks and the rewards are. So let's get into it right now. So starting with the futures, we've been noticing a pattern that the market has been opening up higher and kind of drifting lower as the day goes on. It's been going on for a few days now, actually for about a week or so. That's not a very bullish sign, especially near market turning points or near upside swings. That's usually telling us the market is cooling off. When the market opens lower and then it heads higher, that's usually a sign that the market is heating up. And you will notice during a very strong bull phase of a market that the markets will open a little bit lower and head higher. And during a neutral or a bearish phase, or before a slightly bearish phase, the market will open higher before the opening bell or at the opening bell or overnight, and then drift lower. So right now, the markets are fairly mixed in terms of, not mixed, they're fairly straight up. The Dow's up 100 points. The NASDAQ is up 72 points. So remember what I told you, the market's going to have two characteristics. It's going to have everything else versus NASDAQ. The NASDAQ, if the NASDAQ 100 is rallying, that means fear is moving into the market. That means the stay-at-home economy is moving back in. If the Dow, the Russell, and the S&P move higher as opposed to the NASDAQ, that means we're going back to the past the stay-at-home environment. So if the NASDAQ is leading, there's the odds that the market is fearful that it's going to go back to where we were last March, April, and May. And if the NASDAQ is lagging, that means the market is hopeful we're going to go back to where we were. Why? Most NASDAQ 100 stocks have not been able to take out their September 2nd high. For example, let me show you what I mean. Look at Amazon. See, it's not even a super buy. It's now just a buy anymore. Let me show you so you see for yourself. Here we go. See that? Look at the date. September 2nd. You can see the date right here in the corner when I point to it. See that? September 2nd. How about Nvidia? See that? September 2nd. Went a little higher here on 11.5, but still, it's not been gradually going higher. It's been moving sideways. Let's look at Facebook. That's another FANG stock. Yeah, see that? September 2nd, right there. Around September 2nd. It doesn't have to be September 2nd, but around September 2nd. My point is, those stocks, those large cap tech stocks that have been leading the market all the way in 2020 have not been outperforming since September 2nd. So very, very important, something to keep in mind. Which could be positive, because you can say that if those stocks are not outperforming, that means the stay-at-home environment is dead. Theoretically, possibly. Although those stocks are stretched out and the NASDAQ gave us over 40% over the last 12 months. So I think that sector's overbought, overstretched out, and I'm not really focused on the top NASDAQ 100 stocks at this time. So in terms of news, we have jobless claims coming out in about 20 minutes. And I'm telling you, the two biggest reports, as far as I could tell, is the retail sales report that came out yesterday. It was awful. It was very, very bad. Let me just show you what I'm talking about. I mean, this was just god-awful. We were expecting -3. We got -1.1. Everything was bad. And this told us that Black Friday and Cyber Monday were not pretty. People need their stimulus check. People are not working. So retail sales are not great, which means the odds of a Christmas rally are greatly reduced. Now, that's the last retail sales report till middle of January. And it's not good. And the retail sector is what usually triggers that end-of-year rally. Now, today we've got housing starts, manufacturing, and jobless claims. I'm not too concerned about housing starts. I think housing starts are going to be great. Interest rates are low. The Fed told us yesterday they're not going to be really doing much. If anything, they're going to be buying bonds to keep rates low. Manufacturing, I think that's going to be okay. We've been seeing fairly good manufacturing numbers. But here's where we have the problem. Jobless claims and retail sales. The number went to like upper 600,000 claims, and now we went back to 853,000 claims. And if this number goes higher, It's going to be a wet blanket for this stock market, folks. I'm not kidding. I'm not joking. We'll know in about 20 minutes or 18 minutes. But again, the number is going higher. And if it continues going higher, if it's going to be 850, 900,000, if it's around 850,000, this is going to be very negative for the stock market, because it's going to prove to us that not only are people not spending money at stores, that unemployment rates are going higher, and there's no COVID vaccine in sight for most people till the end of the first quarter of 2020. And that's a big, big problem. That's a big, big problem. So now with that, let's kind of summarize the global economy. I kind of want to give you guys a good perspective of where we stand. And also, with that said, momentum levels on the S&P, folks. Look at that. That's the 50-day. That's a 5-year. Let's look at 20-year. Look at that. Looks like we're turning down. And if we look at momentum levels on the NASDAQ, which we'll do right now. Yeah, here we go. And I just want to look at the 50-day. The 200 days just grossly overbought. It was near 90th percentile. You see where we're at right now on a 20-year basis? Let's go to a 5-year basis. Yeah, that's not good. We topped out right here after the bounce from the crash earlier this year. And then this is how far we've gone up. And usually, as you can see here, when we hit that red zone, we back off. When we hit that red zone, we back off. And you can see we're very close to that red zone, which is at the 89th percentile, which would tell us that 90 out of 100 stocks in the NASDAQ 100 are trading above the 50-day moving average, which is overbought. Now, with that, let's talk about global economy. World shares were mostly higher on Thursday, not by a huge amount. Don't hold your breath. Hopes Congress may finally deliver fresh aid to help businesses. If I was a politician, I'd wait for the new president to take office so he can take credit for that. That's a political move. I'm not a politician. I'm just talking. Investors were encouraged by Federal Reserve's pledge yesterday to keep buying bonds until the economy is greatly improved. Nothing new there. Congressional leaders also appear to be on the brink of a COVID-19 economic package. Again, it would be great to see that. That would be a great way to end the year, and it would give us some upside to this market that would extend help to individuals and businesses and ship COVID vaccines to millions. Again, don't hold your breath for us, the shipment of the vaccines. According to most doctors, people who don't need it badly, it means normal, healthy people, are not going to get it till March, April, May of next year, which means the first quarter of 2021 is going to be screwed, in my opinion. Negotiators were working on a $900 billion package that would revive subsidies for businesses hit hard by the pandemic, help distribute new vaccines, fund schools. Yeah, I'd like to see that. And renew soon to expire jobless benefits. They're also looking to include a new direct payment of about $600 to most Americans. That would go a long way during the holidays. That would help retail sales. Hello, hello, right? You see how everything works together? Optimism over a possible U.S. stimulus deal after many false starts, including probably this one, has been tempered with concerns over a resurgence of COVID. Folks, I'm telling you, we're kind of like between two different worlds. Going back to normal, COVID resurgence first quarter of 2021. And again, I'm concerned because even if we get the medicine, we're not supposed to get it. Like my doctor told me, you're not getting the medicine until March, April, May of next year. So what happens to people like me who need to work first quarter of 2021? That's a problem. Massive effect by the Fed has helped underpin the market since the spring. Oh boy, it sure has. And the central bank said Wednesday that it will buy at least $80 billion in treasuries each month and $40 billion in agency-backed securities until the substantial further progress has been made. That's wonderful. Meanwhile, Bitcoin is topping 20,000. Why? Because US dollar is so low. Investors are getting nervous. They're putting their money in alternate assets. They're nervous about the state of the world economy for good reasons. But I'm going to tell you, with this much money the Fed putting into the US economy, I think things will be okay. We may have some more bumps in the road. And yes, the stock market is stretched out. But that doesn't mean all it needs is a little pullback before going higher. I'm not suggesting we're going to have a massive crash. I'm just saying that rubber band is really stretched out. As you could see here by the number of stocks, 87 out of 100 stocks trading above the 50-day moving average. And the S&P, if we look at the S&P out of 500 stocks, let's just quickly do that again, because I know you guys want to. Let's see here. Here we go. if you look at the indices, you will see here 80% of stocks are trading above the 50. That's 400 out of 500 stocks are trading above the 50-day moving average. And look at this. You got to see this. This is the S&P 200-day line. 90%. So you're talking 450 stocks, and look where we're at. This is the 90% line, or like the 88% line or something like that. Look at this. Highest momentum levels that we've seen. Here, let me give you some drawing tools. Here, how about rectangle? Look at that. That's the highest momentum levels on a 200-day line we've seen in 5 years. Let's go to 10 years. Yep, 10 years ago. This is the highest momentum levels on the S&P 500 in 11 years. So when I say the market's overbought, it's overbought. Look at that. 450 stocks out of 500 stocks are trading above the 200-day moving average. That's an extremely bullish market, and a market that needs to cool off. Now, with that said, I am seeing right now two sectors getting some love, okay? So I want to kind of give you some broad perspective. The first sector is retail. We may not have a Christmas rally, a huge Christmas rally caused by retail. The word is still out. I think the jobless claims is going to cement the fact today that it's not going to happen. But retail is still moving higher or staying up. This L Brands, this has been a top stock for the last several months. Let me go back to my time back machine 3 months ago. Where's L Brands? Here it is, L Brands. Where it is now, it's like in the same place. L Brands right here. So 3 months, the stock has been in the top 5, 10 stocks. That's the power of this relative strength scan. So Nordstrom's, Kohl's, Coach, L Brands, Under Armour. That's where the money is going into right now. And it's also going into chip stocks, Lam Research, Applied Materials. Where's Applied Materials? Where's Applied Materials? Come on, here's Applied Materials. So you got Applied Materials, you got Lam Research, you got Micron, you've got Xilinx. So I am seeing right now a good flow of money moving into semiconductors and retail. Now, I wouldn't be doing individual stocks. I would be doing ETFs because markets are overbought, as you saw right here. XRT. XRT is a retail ETF. If you look at the constituents, you will see that it has Nordstrom's, Kohl's, Chewy, Guess, all these stores that are moving higher. Some online, some are not. But an ETF may be better near turning points. It has L Brands. It has everything in it. XRT. You could see the chart here. I recommended it yesterday, and it's holding up fairly well so far. Here's a 6-month chart, so you can kind of see it's basing out right now, which means it could go a little higher, although you got to be careful. But that's the sector money's moving into. And here's the semiconductor, SMH. These are tradable assets. XRT for retail, SMH for semiconductors. And it's also a strong buy. And you will see in a second, notice that it made a higher high, went down, now it's congesting, moving back up. This is a tradable asset, constituents. All the goodies, NVIDIA, Lam Research, Micron, Applied Materials, Qualcomm, AMD, TSM, all the good stuff is here. So you don't have to buy individual stocks near turning points. You can buy the XRT retail ETF or the SMH semiconductor ETF and keep your eye on the jobless report. I'd like to see the number sharply lower, like 750,000, 700,000. I'm hoping. I'm really stretching and hoping. But I think the number's going to be above 800,000. And that's going to confirm what I'm fearful of, that COVID rates are spiking and are finally interfering with jobless claims again. Now, before I let you go, I've got something really important for you. Isn't it interesting how Wall Street always seems to be one step ahead of the average Joe? Why is the name always Joe? How come it's not Bill or Frank? How come Joe always gets it here, right? We got to change the name from Joe to something else. I'm just giving you a hard time. But seriously, how come Wall Street always is one step ahead, or it seems that way, of the average Joe? Well, it's because they have a ton of top secret trading strategies that give them an edge over everyone else. What else could it be? And while their methods are usually kept under lock and key, former hedge funder insider Lance Ippolito has decided to pull back the curtain on Wall Street's best kept market strategy. Lance is he's finally revealing how tracking something called the Shadow Blitz can help you predict which stocks are ready to explode. Man, Shadow Blitz is you got to check this out. I mean, I was looking at this. I was talking to Lance, and I was looking at this the other day, and I was like, Lance, this is really good stuff. You got to show this to people. This can potentially hand you large, huge cash windfalls in as little as 24 hours. You really should check it out. These are stocks that are ready to explode, and I mean explode in the right direction. Click on the link below to see how you can use Lance's discovery in your own trading. Check it out. It's not going to be online for a long time. Check it out. Give yourself an unfair advantage and trade better than the average Joe. Or if your name is Joe, well, you can finally compete with Wall Street and get that unfair advantage. At least that's what my hope is. All right, and you got to check out Lance. Lance, this Shadow Blitz, he's a former hedge fund insider. He knows how to trade this stuff. He has a lot of knowledge. He can help you hand windfalls in as little as 24 hours. You got to check this out. And most importantly, I'll talk to you tomorrow. Leave me some comments, feedback. I need feedback. I want to know what you guys want to hear, what you want to see, and if you're getting any benefit from this. Post your feedback right there or send me an email at support@marketgeeks.com, and I'll talk to you all later. Bye.